ECN listeners, this is your Forex market commentary brought to you by Real ECN. This week's commentary will encompass the Euro-dollar market. A dramatic and volatile price action in the Euro-dollar market over last week's trading session as the FOMC minutes upgrade investors' expectation of a Fed rate hike by 2015. Despite a softer than expected US leading economic indicators coming in last week, the euro continues to trade lower, leaving analysts expecting a corrective bounce in the single currency as indicators suggest an oversold euro market. This commentary will be broken down into two components. The first component that we will explore is the technical aspect of the euro-dollar market. What a volatile trading week it was for the euro-dollar market as the single currency continued to establish new lower lows. Long-term technical outlook on the price action of the pair is very indicative of a consolidation, and monitoring the development of the price action can give investors a glimpse into how far the bear will continue to hold a tight grip on the pair. After breaking below the support tier at 1.2905 during last Friday trading session, the 1.2806 level has proven to be a solid support since June of 2013. Currently, the pair is trading slightly above the 14.6% Fibonacci expansion marked by the 1.28713. And according to the SSI, which is commonly known as the Speculative Sentiment Index, retail open long and short positions have completely converged, which entails the emergence of a neutral short to long interest at a ratio of 1:1. This trading behavior is very indicative of the indecision that retail traders have on the euro-dollar pair. Nevertheless, as short interest on the pair is beginning to gain traction, contrarian trading warns of a corrective bounce in the near term for the single currency. The shift in net sentiment for the long positions from long positions since the pair broke below the 1.3600 mark to a short position in recent weeks has analysts convinced of a corrective bounce. If the pair can sustain trading momentum above the 1.2860 level, analysis of a collection of technical indicators on the hourly time interval on the euro-dollar cross is suggestive of a temporary bearish market sentiment and recommend short position on the euro. The euro-dollar cross opened today's Sydney's trading session 8 pips below the established Fibonacci support at 1.2830, while the Fibonacci resistance is set at 1.2842. Since the euro-dollar correction to the downside, the pair haven't managed to break above the 200-day simple moving average during the end of last week's trading session. Therefore, this is very indicative of a long-term bearish outlook on the cross moving forward if it cannot hold above the 200-day simple moving average. This bearish standpoint is also validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5, 10, 20, and 30-day simple moving average, which is indicative of a sell recommendation on the short-term moving average front. Moving along to the fundamental component of the euro-dollar commentary. During last week's trading session, investors saw the euro lost 100 pips against the greenback as technical selling continued to keep the pair under pressure. Nevertheless, the one-sided negative print did not extend to last week's eurozone fundamental. The eurozone posted a better than expected CPI year-on-year print at 0.4%, beating a forecast of a 0.3% expansion. In addition to that, the eurozone current account posted a surplus, with German PPI month-on-month coming in line with expectation with a contraction by 0.1%. The ECB clearly understand the deflationary pressure that the eurozone is facing. Last week's announcement of its latest LTRO program aims to boost lending velocity by the financial sector. This means that the ECB balance sheet is likely to expand by 82.3 billion euro. There are numerous number of risk events coming out from the eurozone this week. On Tuesday, investors can expect the release of the French manufacturing PMI forecast to come in at 47, whilst German manufacturing PMI is forecast to roll in at 51.2. In addition to that, German service PMI is forecast to come in at 54.6, while the eurozone manufacturing PMI is forecast to read at 50.5. On Wednesday, German IFO Business Climax Index is likely to introduce a certain degree of volatility in the euro-dollar market, which is expected to come in at 105.7. German current assessment is also expected to come in at 110.2. Over in the United States, last week's greenback rally continues to sustain the 10-week bullish rally that the dollar has enjoyed. This has left many analysts believing in that the dollar may possibly be overbought. Nevertheless, investors' growing appetite for the greenback interest rate expectation will continue to be fuel the demand of the greenback. Last week FOMC meeting showed that the second to last tapering of the Fed QE program, with October marking the completion of its QE program. Investors are closely monitoring Yellen's language to gauge whether her dovish standpoint on monetary policy have changed. However, the chairman was adamant about keeping to the continuity of her current monetary policy, which is keeping interest rate near 0% for an extended period of time once tapering comes to completion. The greenback, however, did rally against the euro during the release of the FOMC minutes last week on the back of a hawkish FOMC where 14 out of the 17 members believe in rising rate by 2015. Expectation is running high for the US benchmark rate to rise by 1.13% by 2015 and 2.88% by 2016. Last week, US Tier 1 and Tier 2 leading economic indicators came in softer than expected. For instance, the US core CPI month-on-month stagnated when expectation forecast a 0.2% growth. In addition to that, US building permit also rolled in below expectation at 0.998 million when forecast set at 1.045 million, while the Philadelphia Fed Manufacturing Index ticking lower at 22.5 below a 23 expectation print. However, the number of risk events is expected to fall for this week trading session. On Monday, investors can expect the release of US existing home sale forecast to come in at 5.20 million, while on Wednesday, US new home sale is expected to roll in 430K. Meanwhile, on Thursday, US core durable goods orders month-on-month is forecast to come in at 0.6%, while on Friday, the highly anticipated US GDP quarter-on-quarter is expected to accelerate by 4.6%, with its GDP price component forecast to read at 2.1%. Lastly, the US Michigan consumer expectation is forecast to roll in at 75. Thank you, everybody, for spending your time with us, and have a successful trading session.